Hello everyone. This video I will introduce the balance sheet, which I believe you have already learned from your accounting class. And this is just to help you refresh your memory. Together, I will introduce a new type of balance sheet called the common size balance sheet. So the balance sheet is a snapshot of the firm's assets and liabilities. Remember, the firm usually has a lot of assets. It include tangible assets and intangible assets. It can also be classified as current assets, which is short-term assets, and long-term assets, which is fixed assets. And those assets are funded by majorly two type of capital. The first is debt capital, which is liabilities, and also the second capital is called shareholders equity, which is the contribution by the shareholders or investment by the shareholders. Assets are listed in the order of liquidity. What's the definition of liquidity? Liquidity measures how easy the assets can be converted to cash without significant loss of value. For example, cash, it has highest liquidity because you can use it immediately. And the inventory, you can sell it relatively easier compared to fixed assets. So the liquidity of inventory is relatively higher. And finally, those fixed assets like equipment, factories, office buildings, those are with lowest liquidity. They are really hard to convert to cash. And when the firm has emergency, when the firm lack of liquidity, lack of cash, they want to convert those equipment, factory, plant into cash, they will have to provide a big discount. So by converting those fixed assets into cash, the firm will suffer a significant loss. So this is the format of balance sheet. So on the left hand side, we list the total all the assets of the firm and the total value of the assets. It can be classified as two categories: current assets and fixed assets. Again, current assets, those are short-term assets. And fixed assets are long-term assets. It can be also classified as tangible fixed assets and intangible fixed assets. And on the right-hand side, we list the total value, liabilities, and shareholders' equities. So we list the current liabilities first. Current liabilities are short-term debt. And also long-term debt, those are debt with maturity longer than 1 year, and the shareholders' equity. So for current assets, we have cash, which has the highest liquidity, account receivables. What is account receivables? Those are other firms own own these firms some debt. For example, this company is a supplier to another company, and this current company provide its customer some credit lines. So those are account receivables because its customer will have to pay back within a short time of period, like 60 days, 90 days, and the inventory. And tangible fixed assets include factories, equipment, plant, office buildings, those physical assets. And intangible fixed assets include patents, copyrights, trademarks, something like that. And the current liability, account payables, that is, for example, credit line provided by the company's suppliers. the company buy raw material and have a credit line from its suppliers, the company have to pay back those short-term debt within yearly 60 days or 90 days. And the balance sheet identity is like this. The total assets should equals to total liabilities plus shareholders' equity, which means that the assets can be funded from two resources, liabilities and the shareholders' equity. And we also need to know there's a very commonly used term called net working capital. It equals to current assets minus current liabilities. So here is one example, this firm called the OZ firm. And it lists on the left-hand side, it lists the assets at the end of the year 2006 and 2007. On the right-hand side, it lists liabilities and equities at the end of the year 2006 and 2007 too. What's the net working capital for 2006? Remember, net working capital is the difference between current assets and the current liability. So in the balance sheet, the total current assets for 2006 is 1,112. These are in millions. And the current liability is 428. So the net working capital is 684 millions. And the net working capital for year 2007, again, is the difference between current assets and the current liability. So the net working capital for 2007 is 1,014 million. Here I would like to introduce a concept called the common size balance sheet. Common size balance sheet basically is a type of balance sheet that we represent each account items as a percentage of total assets. So here you should remember it's as a percentage of total assets. So for example, for this company, the total assets is 8,467,138. So the cash is this, if we represent it as a percentage of total assets, so it's equals to 150,000 divided by the total assets. So it equals to 1.77%. So we represent every items in the balance sheet as percentage of total assets. So here is one example, one practice for the balance sheet. A firm has an inventory of 46,500 inventory. Account payables 17,400. Cash 1,250. Net fixed assets 318,680. Long-term debt 109,500. Accounts receivables 16,600. And then ask you to prepare a common size balance sheet, especially find out the common size percentage of the equity. So the first thing we need to find out the shareholders' equity and the total assets number. So we prepare this balance sheet first. So cash, on the left-hand side, we list all the assets with respect to the liquidity. So first there should be cash. And it tells you that cash is 1,250. And accounts receivable is 16,600. Inventory is 46,500. Total current assets is the summation of those three, so it's 64,350. And the net fixed assets, and then we find out the total assets is 383,000. So on the right-hand side, we list the liabilities first, then shareholders' equity. And here, the problem didn't give us the number of shareholders' equity, so we needed to find out it. And remember the balance sheet identity, which is total assets equals to total liabilities plus equity. So if we want to find out total equity, we need to find out the total liability. Then the difference between the total assets and the total liabilities is the shareholders' equity. So we put the current liability first. Accounts payable, which is short-term liability, is 17,400. Long-term debt is the number is given is 109,500. Total liability is the summation of those two. And then equity is the difference, liability plus equity should equals to the total assets. So equity should be the difference between the total assets and the total liability. Then we know the common sense percentage of equity should be we should calculate it use the number of equity we get here divided by the total assets. So it's 66.87%. The second example, a firm has a current assets of 100, net fixed assets of 500, long-term debt of 70, and the long-term debt of short-term debt of $70 and the long-term debt of 200. Ask what's the shareholders' equity. So we know the assets equals to current assets plus net fixed assets is $600, and the total debt is short-term debt plus long-term debt. Then the equity should be the difference between assets and the debt. So it's 330. And we can prepare a balance sheet. On the left-hand side is assets. We list the current assets first, then net fixed assets and the total assets. On the right-hand side, we list the liabilities and the equity. And the liabilities first, current liability first, long-term debt next, and that's total liability. And we list the equity. And finally, we can find out that liability plus equity should equal to total assets. And the net working capital is the net current assets minus current liability. So it's 30. We copy the previous balance sheet here, and what's the common sense balance sheet looks like. So we just divide every item by 600, which is the total assets. So which shows that the current assets accounts for 16.67% of the total assets. Net fixed assets accounts for 83.33% of the total assets. Current liability accounts for 11.67% of the total assets. Long-term debt accounts for 33.33% of the total assets. So we found that the total liability accounts for 45% of the total assets. And equity accounts, total equity accounts for 55% of the total assets. So the next practice, a firm has a current assets of 1,000, net fixed assets of 500, short-term debt of 500, and long-term debt of 100. Then what's the shareholders' equity? So again, equity equals to total assets minus total liability. Total assets equals to current assets plus net fixed assets. Total liability equals to current liability plus long-term debt. Then finally, we found the equity equals to 900. And then the balance sheet looks like this. Again, we put on the left-hand side, we put assets, current assets first, then fixed assets, then total assets. Is the summation of total assets is the summation of total current assets and net fixed assets. On the left-hand side, we list the liabilities and equity. And the current liability is 500. Long-term debt, then the total liability is the summation of current liability and long-term debt. And then next is equity. And the next question was net working capital. So the net working capital is the difference between current assets and the current liability. So it's 500. What's the common size balance sheet looks like? So again, we just divide all the items on the balance sheet by the total assets, which is 1,500. So we found that current assets account for 66.67% of total assets. Net fixed assets account for 33.33% of the total assets. Current liability accounts for 33.33% of the total assets. Long-term debt only accounts for 6.67% of the total assets. Finally, we found out the total liability accounts for 40% and total equity accounts for 60%. Those two add up to 100%. Next one, prepare the balance sheet for Alaskan Strawberry Corporation as December 31st, 2016, based on the following information. We should know cash is current assets, accounts payable is current liability, tangible net fixed assets is fixed assets, notes payable is current liability, long-term debt is debt. Patents in the copyrights are long-term assets. Accounts receivable is current assets. Inventory is current assets. Accumulated returned earning is equity, is shareholders' equity. And common stock is equity too. So we just put it in the balance sheet with those numbers, and then we can figure out the total current assets is the summation of cash, accounts receivables, and inventory. Total fixed assets is the summation of tangible net fixed assets and the patents in the copyrights, which is the intangible assets. Total assets is the summation of total current assets and total fixed assets. On the right-hand side for the liability and equities, total current liability is a summation of the accounts payable and notes payable. Total liability is a summation of total current liability and long-term debt. Total equity is a summation of the accumulated returned earnings and common stock. And the liability plus equity is the summation of total liabilities and the total equity. And this, the total liability plus equity should equals to total assets. Next practice, again, prepare for a balance sheet. So it's a similar stuff. So cash, account receivables, inventory add up as total current assets, and tangible net fixed assets plus patents and copyright equals to total fixed assets. And the total current assets plus total fixed assets is total assets. And for liabilities, total current liability equals to accounts payables plus notes payables. Total current liability plus long-term debt is total liability. And the total liability plus total equity equals to liability, and equity should equals to total asset. And the total equity here equals to accumulated returned earnings plus common stock. Here I didn't put a total equity here, so you can put it by yourself. It makes a small difference but it doesn't affect the calculation. Okay, I think I'm gonna stop here. And the next video, we will talk about the income statement.